Good evening, everyone. Can everyone see my screen? If you can see my screen, just give me a yes in the chat box. Wonderful, wonderful, wonderful. Thank you, Ken. Thank you, Jennifer. I hope everyone else is doing well. I was just trying to give everyone else a chance to get on from the start. It's 2 minutes past the hour. So we may as well begin. Okay, so this evening we'll be doing moving averages plus the Elliott wave theory. Basically, what this means is we'll be applying the Elliott wave theory to moving averages, okay? On my last class, you guys may have had a little sample of it, but this evening I'm going to focus a little bit more on it, okay? How many of you were in the last class? Just give me a show of eyes, okay? Just give me an eye if you were in the last class. Just drop an I in the chat box. Okay, okay. Good evening, Ryan. Anyone else was in the last class? Okay, so this evening I'm going to have to focus a little bit more on moving averages as well. Okay, well, we do have previously recorded classes on the Elliott wave theory. So for those of you who are not familiar with the Elliott wave theory, you can always go back to some of our previous classes. And for those of you who are not so familiar with the moving averages, you can go back to my previous class as well. Okay, this evening, I will try to focus a little bit more on the application of the Elliott wave theory to moving averages. Okay, so let's jump right into it. Now, here I am on a chart. It's just a random chart. You guys can select whatever chart you'd like us to look at. Okay, so what chart would you guys like us to look at? You guys know I like it when you let me know what chart you'd like us to work with. So just give me a chart. You guys know I favor charts from the European and or US session. Okay, I see Ken says pound Japanese yen. Not really my favorite, but I'll do it for you anyway. Okay, since you were the, well, I see Ryan said gold, but I saw pound Japanese yen first. So I'll go with that one. Okay, so pound Japanese yen. Let us see if I can find it on my list right here. There you go. Okay, so we have pound Japanese yen up, and I'm just gonna pick a random spot. I don't want to go back too far. So I'm just gonna pick a random spot, okay? I'm just gonna go back. Let's see. Let's go back some more. Okay, let's pull it one more time and we can work from, let's say we work from here. Anywhere inside here we'll start from, okay? So moving averages. I see Ryan says, nope, wasn't there, too late, but now around 1 a.m. here. Okay, so it's very late on your end. Okay, okay. You could have caught the recording. All right. So thank you for coming, by the way. Thank you for coming. I appreciate it. Okay, so here we have the pound Japanese yen. And for those of you who were at my previous class, or those of you who are not at my previous class, I'll tell you a little bit more about these moving averages that I have on my chart. So you can see here I have a red moving average, a yellow moving average, and a, well, let's call it a light blue, okay? This is, the red one is the 400 period moving average. The yellow one is the 200 period moving average. And the blue one is the 50 period moving average, okay? Now, what I like to do with these averages, these moving averages, is to give me an idea of what the longer term price is, well, average price is, what the medium term average price is, and what the shorter term average price is. Okay, so this is going to give me an idea if the price is bullish or if the price is bearish. Okay, so I want to see these moving averages in a particular order. I want to see the red one below, the yellow one in the middle, and the blue one at the top, which is 400 below, 200 in the middle, 50 at the top. Okay, that tells me uptrend. All right, that tells me uptrend. If I have the red one at the top, the yellow one in the middle, and the blue one at the bottom, that tells me downtrend. Okay, I see Ryan says, so this is for long-term trading and use SMA 1020 for scalping. No, this is not necessarily about long-term trading. It's not about scalping. It's I'm more of a day trader, right? I can swing trade with this as well, but I'm more of a day trader. Okay, so I'm using this and I'm looking for setups during the course of the day. All right. Okay, Jennifer says, are these are simple moving averages. So Jennifer's asking if they are exponential moving averages or simple moving averages. They're all simple moving averages. Let me just show you. See, simple, simple, simple. Okay, all simple moving averages. All right. Just wanted to give you guys a look at the settings. They're all simple moving averages. All right. So remember, 400 below, 200 in the middle, 50 at the top, bullish. 400 at the top, 200 in the middle, 50 at the bottom, bearish. Okay, let me see if I can find an area where it shows nice and clear. Looking for an area where it's nice and clear. Okay, this is a nice area where it shows, right? Let's start from this area here. You can see there's the 400 at the top, the 200 in the middle, and the 50 at the bottom. That's telling you that the price is more on the bearish side. Okay, and as you can see, the price continued moving to the downside until it changes. All right, we're not necessarily going to be excited to get involved in trades if it goes past the 50 period moving average. Okay, so if the price comes and closes above the 50 period moving average, we're not going to be too excited to get involved in the trade. What we want is to get involved in trades that are more in line with the short-term direction. Okay, so if the price is bearish short-term, then you're more excited to get involved in those trades. Okay, so typically what we'll be looking for is for the price to come down and pull back and retest the 50 period moving average. Okay, so what we're going to be looking for is, let me just go back to the area where we were. We can start from anywhere, but okay, can't recall where we were, but we're just going to go back some. Okay, I'm going to go back. While I'm at it, areas where you find these moving averages are not in the order that I mentioned, which is for bullish, we have 400, then 200, then 50. We're not really going to be looking to get involved in setups like that, okay? Because what it's saying is the price is more or less in a correction. It's balancing off. It's just going sideways, okay? You want the moving averages to tell you that the trend is going down or the trend is going up, okay? So look at this area. It's not in an order. It is 200 above, 50 in the middle, 400 at the bottom, and they're basically crisscrossing around, flip-flopping around. They're not taking on the order that we're looking for, okay? So this would be telling you that there is a high possibility that the market is in a correction, which means it's going up and down, up and down. It's not trending, okay? So once we have an order of 400, 250, we're trending. If we have 400, 250, being at above, we're trending up. We have 400 above, 200 in the middle, 50 below, we're trending down. Okay? So remember, 400 below, 200 in the middle, 50 above, we're trending up. 400 above, 200 in the middle, 50 below, we're trending down. Okay, so that's what we're looking for. We're looking for higher probability setups. Now, in the market, there are many setups that we can use. This is just one of them. Now, let's look at this area here. Here, let's see what the time is. This is about 9. So this is going to be 2 a.m. Eastern Standard. Okay, 2 a.m. Eastern Standard. I look at that as the open of the European session, right? So the market's going to start moving around that time. It's going to start moving around 2 a.m. Eastern Standard. Why? Because it's the European session, and the European and US session make up the higher volatility sessions. So from 2 a.m. to 12 p.m. Eastern Standard or 4 p.m. Eastern Standard, that's where you're going to see the most volatility on average. Okay, so I say on average because in some cases you do see volatility after the US session into the Asian session, leading up to the European session. But the most volatility that you will find on average will be coming out of the European and US session. Okay, as these are the most traded sessions. All right. I see I have Ryan with a comment here. Can you add that as bullet notes on those places like in a cheat sheet? Okay, well, you can create your own cheat sheet. Just you know, make your notes, or you can rewatch the video, take your notes as you go along. You can do that as well. Okay. Grace says red 400, yellow 200, blue 50. That's up. Yes, so red at the bottom, yellow in the middle, blue at the top. That would be uptrend. Okay, now I'm using the color coordination, but you don't have to do it in the same colors. To do it in the same colors would be making it a lot simple, but you can color them however you like. So just remember them by number. 400 at the bottom, 200 in the middle, 50 at the top, uptrend. Okay. Downtrend, 400 at the top, 200 in the middle, 50 at the bottom. That's a downtrend. Okay. So uptrend once again, 400 at the bottom, 200 in the middle, 50 at the top. That's uptrend. Downtrend, 400 at the top, 200 in the middle, 50 at the bottom. That's a downtrend. Okay. Oh, Grace says I was helping Ryan with his cheat sheet. Okay. Thank you so much, Grace. All right. Okay, so let's jump right back into it. So here you can see that a clear downtrend was developing once we have this alignment of moving averages. Okay, now when I find this alignment of moving averages, what I want to look for, well, one of the things that I want to look for is the Elliott wave theory. Okay, so we have a strong move down, and I want to see that pullback because this strong move is telling me that I have a potential impulse to the downside. Okay, so what I want to see is a pullback. Now, if I'm trading moving averages, I want to see that pullback at least coming back to the 50-period moving average, right? So I'm looking to see how that pullback forms. So according to the Elliott wave theory, a correction is a 3-wave move, right? So just to keep it simple, what we want to find is a nice 3-wave move. Let me see if I can annotate. Yes, I think I can. Okay, my mouse is not showing, so I'm going to leave that alone. Okay, I'm going to leave that alone because when I click on annotate, for some reason, my mouse is not showing. I think Zoom did an update and it's just not perfect just yet. So maybe with the next update, it'll be perfect. Okay, so I'm going to have to leave the annotate alone. So I'm going to use this, right? So we have 1 move, 2, 3, right? We have a nice 3-wave move, but in this case, I didn't get the 3-wave move all the way back to my 50-period moving average, right? And I want to see that come in at a certain time as well. So if it comes in at around 2 a.m., between 2 a.m. and 8 a.m. Eastern Standard, that's going to be the opportune time for me to look to get into the market. But as you can see here, it completed in the Asian session and we got this move down coming from the Asian session into the European session. So as I said before, we do in some cases see moves in the Asian session. Now this pair is European and Asian. So the time in which this pair moves would be a little bit different from the time in which a pair from the European session and US session would move. So you'd have to keep that in mind as well. And that's one of the reasons why I like trading pairs from, for example, Euro USD, Pound USD, Euro CAD, and so on. These pairs are European and US session pairs, okay, while we're looking at a European session and Asian session pair. Okay, so we will see moves in the Asian session. So I would have to adjust to match this type of move, right? This type of pair, okay? Because we will see moves in the Asian session at times, okay? So here you're seeing that we got a 3-wave pullback and the price did continue moving down, but it's happening in the Asian session. What I want, if I'm trading a European and US pair, are pairs from the European session and the US session, I'll be looking to see that pullback end around the start of the European session to the start of the US session. So anywhere inside of that time slot is where I'll be looking to see that corrective move end. I'm looking for a 3-wave correction to end at that time. If it hits the 50-period moving average, that's going to be a very good indication to me that we could be going down again, okay? Because I'm looking at the 50-period moving average as an area of support or resistance. Now, in this case, it's going to be resistance because I'm expecting it to come and touch it. Once it touches it, I'm not expecting it to go past, okay? Because I'm looking at a downtrend. I'm expecting price to continue going down. In this case, it was a very strong downtrend, so it didn't come back to the 50-period moving average, okay? Let me see if I can find you guys some, okay, let's see here. Okay, this one is a bit clustered up. So we don't have the order that we're looking for. We're still in some sort of correction here. Here we have the order that we're looking for. And here you can see we get a pullback. This one doesn't quite look like it. Let me just make this a bit bigger. This one doesn't look like it quite hit that 50-period moving average, but it did come very close. Now, for those of you who understand the Elliott wave theory, this is 1, 2, and 3. Let me just try to draw it in for you. We have 1, we have 2, and we have 3, right? So excuse my drawing. So we have 3. We have a 3-wave move. We have up, down, up. That's a 3-wave move. Okay, just trying to keep it simple. Once we get that, you can see here that it did come pretty much close enough to hit the 50-period moving average. And look at the time in which it's happening. It's happening within the beginning of the European session and the US session. And this is the period where we have the most volatility in the market, right? So this would make this a higher probability setup because it came to the 50-period moving average. We are in the downtrend order in terms of the moving averages, and we should be finding some sort of resistance at the 50-period moving average. And once we find resistance there, we can go short. Okay, we can go short, we can hold it, we can swing it if we want. We can look to take the trade short and close out the trade using any other methods. I won't get into the other methods right now. We'll take those on in a later class, but we could use a lot of other methods to exit this trade. Okay, we're going to focus a little bit more on the entry aspect of it just to catch the direction. Okay, so once you have a complete three-wave correction to the moving average, which is the 50-period moving average, then you can look to go short because you will be expecting some sort of resistance if you're in a downtrend to push that price back to the downside. Okay, so this is a perfect example of that, where you have price correcting back to the 50-period moving average and the 50-period moving average pushing that price down. Okay, you can see it comes down. And at this area, it's approximately, it's about 11 a.m. Eastern Standard at the open of this green bar, 11 a.m. Eastern Standard. Now, typically around that time, 11, 12, around that time, the market tends to slow down, goes into correction into the Asian session. So at that time, if you'd like to get out of the market, that would be the best time for you. So time kind of gives you an idea of when the move is going to end. Okay, time is one of the foundation blocks in trading. So that is something that you would want to make sure that you pay attention to, that time. Okay, so time is very important. So here you can see we got the move off the moving average. It's correcting again. We want to make sure that we bank our profits for the various reasons that we will have. If you want to use time to bank your profits, generally, I want to get out of trades by at least 12 p.m. Eastern Standard. The latest, just before the close of the market, which is 4 p.m. Eastern Standard, right? So around 4 p.m. Eastern Standard, I want to make sure that I'm out of my trades, all right? So anywhere between 12 and 4, I want to be out. Generally, after 12, volatility kind of dies off. So you don't really want to be in the market after 12 p.m. Eastern Standard, okay? So we would have been able to catch a nice move down here. If we're looking at day trading, we would have caught a nice move down here, okay? And we would have probably exited our trade in this area for whatever reason we looked at. If you look at the RSI here as well, the RSI is in the lower extremes, which most traders refer to as oversold, right? So with the RSI being in the oversold condition, very good reason to exit as well, okay? Because the RSI is already on the oversold condition. So it's saying that price may be exhausting itself, especially after getting in the oversold condition, getting this green bar close. That's a great indication that we may have exhausted ourselves in the direction to the downside in the short term, okay? As in for today, okay? So that was a nice example here. Let's see if we get another one. Here you can see the price is correcting back to the moving average. However, we have the price closing above the moving average. If the price comes and closes above the 50-period moving average, when you're looking for a correction, it's best not to get involved, okay? You don't want the price closing above the moving average. You want the price closing below. So if you have a situation where the price closed above, you're not going to enter. You're going to wait for the price to come close below. Okay, so if it closed above and came back and closed below, then that would be a nice indication that you can go short. But it closed above, you have to wait. You're not going to get involved. Okay, so in this case, it came back, it closed above, we leave it alone. It continued moving up, it continued moving up. This could be an early sign that the price may be looking to shift directions. And when I say shift directions, I mean change from a downtrend to an uptrend. Okay, so here you can see it's moving up, it's moving up. It went all the way above the 400 period moving average, and it's starting to come back to the downside. But as you can see, we don't necessarily have the order that we're looking for from around this area. Okay, so from around this area, we don't have the order that we're looking for. We have the 400, then we have the 50, then we have the 200. So that is telling me that we're in a potential correction, right? So we don't want to get involved at that time. We want to leave it alone. All right. So we're leaving it alone. And here you can see we have the order that we're looking for. Anywhere around here, you can see the order starts to come in. We have the 400, then we have the 200, then we have 50. So that's telling me downtrend again, right? So once I have a downtrend indication from my moving averages, what I'm looking for is a pullback. I'm looking for that pullback to the moving average. When I say that pullback to the moving average, I'm talking about that pullback to the 50 period moving average. Okay, so once I get that pullback to the 50 period moving average, I'm looking to take this short. Okay, because the moving average is telling me that the average price is bearish, right? So the moving average is what's talking to me. It's telling me that expect the average price to be bearish. So here you can see the price came back to the moving average. We didn't close above on the first touch. The next bar closed slightly above, and then we have a red bar closing below. With us getting this red bar closing below, I would look at that and say, okay, we potentially may have a situation where the price is looking to go down. Okay, price goes down, comes back, retest the moving average again. Okay, comes back, retests the moving average and pushes down again. We have it closing below. Once we get a close below, that's a nice indication that we could be going short. Okay, so we have it come, hit the moving average, close below. We can go short at that time because we closed below the moving average. The moving average is telling us that we are acting as an area of resistance. So we kept the price below the moving average. And if the price is kept below the moving average, that's a nice indication to go short. Okay. So if we went short, you can see we'd catch a very nice move down. So either we went short on the close of the green bar, or if you would like added confirmation, you can wait for the close of a red bar. Okay. And with you getting the close of a red bar, you can go short, and you can see here that you'd have caught a nice trade. Okay, whether you entered on the close of this green bar or the close of this red bar, the stop would have been placed above the high. So you would have been able to catch this move to the downside either way, whichever one you chose to enter on. Okay. And in terms of a correction based on the Elliott wave, this would be 1. And you got 2, and you got 3. Now it is a very sharp 3-wave correction, okay? But since the moving average is telling us that we're in a downtrend, we can look to get involved in this trade because the moving averages is saying that this is a downtrend. So this sharp move to the upside is most likely a impulse to the upside, yes, but it's a corrective impulse, which means that it's the first impulse of a bigger correction. Okay, so with the moving averages telling us that we're in a downtrend, that would help us to identify that this is possibly a impulse of a bigger correction. And so we would look to sell this. And as you can see, if we sold this, it went right back to the bottom, and then it pulled right back to the moving averages again. However, in this case, you can see here that we're making a little bit more of a complex corrective formation. It's going, let's see here. It's going 1, 2, 3. As you can see, it made 1, 2, 3. Let's try to make that look nice. Good, we got 1, 2, 3. Now, it came very close to the moving average. Now, we don't necessarily have to see it touching the moving average would be very good, but once we get a full three-wave correction, not in every case, it has to hit the moving average. Because if we use other methods, for example, market geometry would give us a nice entry in this area because it would be showing us that we have these measured moves. And if we rely on the measured moves to complete our correction should be done here. Now, in cases like this, where, as you can see here, it didn't hit the moving average, you could get these types of moves. Like it's sort of like a false impulse, right? Where it gives us a nice move down, but then it cuts it short and pushes price back to the upside again. Okay, so this is also an Elliott wave formation where you go WXY, that's a three-wave move, then you get X, and then you get Z. So this makes it sort of like a five-wave move, but it's like a double correction. You got 1, 2, and 3. So this is still a three-wave move, right? That's still a three-wave corrective move. So if we're looking at this as a three-wave corrective move, it would look more like, let me just adjust this. It would look more like this, right? So this would be 1, 2, and 3. So you can see here that the third wave is hitting the 50-period moving average. We did close above, but the next bar came back and closed below. With us getting the next bar coming back, closing below, that is a nice indication to go short. And if we went short, the stop would be just above the high, and we'd be going for wherever we aim for as our profit target, whether you use market geometry to set your profit target, whether you use order blocks, a set number of pips, whatever your target is, whatever your reason is to set a take profit, you can use that, okay? So if our take profit was just at this low, you can see here that we would have been able to get to our take profit. As you can see here, I dropped that line. So you can see that we'd be able to get to our take profit. And as a day trader, around that time, when we get to our take profit is when I'm looking to exit the market. If you're a swing trader, then you may be looking to hold on to the trade, expecting that the price will not go beyond your stop, right? And that's if you're looking at the longer term direction of the market. So for example, the stop is up here. You got into the market to the downside. If as a swing trader, you're expecting price to move to a long-term level to the downside, then you could be holding on to your trade until it gets there, okay? As a day trader, you may be looking at shorter profit targets. So you may be looking at the previous low, okay? Or the lowest low that the price made so far. So for example, here, this would be the lowest low at the time. So you'd be aiming for this low, or you may be aiming for some other target, okay? If you were aiming for this low, you would have been able to make that and get out before the close of the day, all right? Get out of the trade with profit. Okay, let me just try to get rid of this line. Good. So this would have been a nice trade setup. Here you can see that we have price pulling back, and it's pulling back to the moving average. But as I said, I don't like getting involved at these times. I prefer getting involved around at the beginning of the European session to the beginning of the US session. Those are my best times to get involved. Grace says, can you try pound USD next? Let's take a look at the pound USD. Where is it? Where do I have pound USD? I got it somewhere here. Or is it that my eyes are, okay, here it is. Thought my eyes were playing tricks on me. Okay, this is pound USD. Pound USD, you can see here that we have all our moving averages in the order for a downtrend. We have 400, we have 200, we have 50, okay? And the price is moving nicely to the downside. It comes over here and it closes above. Once it closes above, you're not gonna look to get involved short unless the price comes back and closes below the moving average. So you let it do its thing. Let the price continue moving up. Generally, if the price is above the 50-period moving average, short term, you're looking at price moving up. Okay, so you're looking short because the moving averages are telling you that the bias is to the short term, because the longer term trend is down, the medium term trend is down, the short term trend is also down. So if the trend changes in the short term period, we're not going to look to go short, because it's only the short term period that has changes. Okay. Once the short term period has changed from short to long, we're not going to go short, we're not going to go long, we're just going to wait for price to come back below the short-term moving average, which is below the 50-period moving average. So here you can see the price is moving up. We're going to leave it alone. We have 1, we have 2. This was supposed to be 3 and then continue back to the downside, but we're having a nice extended wave here. So we're going to watch this one, see if this could be the reversal to the upside, making this 1, 2, 3, 4, 5, then you get a 3-wave correction, then it continues moving up. We will see how that plays out. And it looks like that's exactly what's happening. Price continues moving up and the trend starts to change. And what indicates a trend change for us, where we have the red, which is the 400 moving average at the bottom, the 200 in the middle, and the 50-period moving average at the top. And here you can see we have that nice order coming in. So this is telling us uptrend. What we want is to see the price stay above the 50-period moving average. We want to see the price pull back, give us a 3-wave pullback to the 50-period moving average, and we're going to try to take it from there. Okay, so we didn't really get that. We didn't really get a nice pullback to the 50-period moving average within the time slot that we want to get into a trade, which is within 2 a.m. Eastern Standard to 8 a.m. Eastern Standard. We didn't quite get a nice pullback at that time. Over here, we were getting a pullback. It closed below. When this one comes back and closes above, we could have looked to go long in a period like that. But that is a bit on the late side if you're a day trader. But if you're a swing trader, then that would interest you. Okay. So not a lovely setup. Over here, this looked like a lovely setup here as well. So over here, we could have been looking to go long, because you can see the price came back. It retested the 50-period moving average. We do have the order for a uptrend. We have the 400 at the bottom, the 200 in the middle, the 50 at the top. But with us getting this long candle here, if we entered to go long, you can see that the next bar came back red, and we would have most likely been stopped out on that one. Okay, and if we were stopped out on that one, that's still not a problem. We're going to wait for the price to settle down and give us some sort of direction. And here you can see that we start to get the direction right around this area right here. Okay, you can see that we have the 400-period moving average, we have the 200, we have the 50, right? So this is telling us that we are in a downtrend. From now on, we can expect price to continue moving to the downside. So what we're going to do is we're going to look for a pullback. We're going to look for a correction. So price is inside here, it's starting to change, and we allow it to go. It goes, it pulls back. As you can see here, it is pulling back. And for those of you who understand the Elliott wave theory, you would look at this as one, right? That is one wave. This is 1, 2, 3. So this is 2, right? And this is 3, right? So here you can see we have a nice 3-wave pullback. Now, it is pulling back directly to the 50-period moving average. It hits the 50-period moving average, which is a great sign. So it hits it and it rejects off of it. So that gives us a nice indication that we can go short, because we have a full 3-wave correction and we have price being rejected by the 50-period moving average. So if we went short, you can see here that we had a nice move down. If you're a swing trader, that's a lovely setup for you. If you're a day trader, this may be coming in a little bit too late. Let's see, when would this come in as a day trader? It'll be coming in after 12 p.m. Eastern Standard. So that would be about, let's say, this is about 2 o'clock Eastern Standard, 2 p.m. Eastern Standard, when this bar has fully been formed, because 1900 hours would be 12 Eastern Standard, 20 would be 1, 21 would be 2, 22 would be 3. So this is basically around 2, 3 o'clock, right? So this is bars opening at 1. No, it's opening at 2 because it's 21. So it's opening at 2 p.m. Eastern Standard, closing at 3. So this would be the type of trade maybe a swing trader would want to get involved with. A day trader, this would be a bit late because it's very close to the end of the day. So that would be a late entry. Okay. But as you can see, we do have a nice setup here, and price did move to the downside nice and aggressively. Okay. Price continues moving down. We're looking for it to pull back to the 50-period moving average, as you can see here. It pulls back, but it's not happening at the time that we want to get into a trade, right? So it pulls back, it closes above. You can see here, we're not going to get involved. It stays above, comes back, rejects, continues moving to the upside. We're not going to get involved in this trade at that time, unless you're trading some other method and you have other reasons to get involved with the trade. Okay, but if you're trading just the moving averages and the Elliott wave theory, that's not a period of time that you want to really get involved in the trade, right? You want to make sure that you see the setup that you're looking for. So price continues moving up, continues moving up, continues moving up, continues moving up, and we have a shift of trend right in this area, right around here. Price is telling us in the long term, we're bullish. In the medium term, we're bullish. In the short term, we're bullish, right? So what are we looking for? We're looking for a situation where we have price pulling back to the 50-period moving average. So right around here, you can see the price pulled back to the 50-period moving average. So in a case like this, where it pulls back, hits the 50-period moving average, closes above it, that's where I would want to get involved to go long. However, if I'm going long there, my stop would be just below. And if my stop is just below, you can see that price came back, stopped me out. Okay. So because the price came back, stopped me out, I would be looking for another opportunity to go long. So here you can see it came back here, got another bar to the downside. We got this green bar closing back above. With us getting this green bar closing back above, that's another indication that would tell me I can look to go long, right? However, price still doesn't go. It pulls back and stops me out again. So in a case like that, I would look at it and say, okay, price may be looking to continue to the downside or stay in correction. So I'm going to have to stay out of this trade. And I'll leave it alone. I'll wait for my next setup. Okay. Price is below the moving average. I'm not going to get involved. We don't have a situation where we have price telling us that we're looking to trend to the upside. Over here, we have a situation where price is telling us that we may be looking to trend to the upside. So in a case like that, I'll be looking for a price to pull back to the 50-period moving average so that I can look to go long, okay? Because we're in a long setup based on the moving average. We have the 400 period at the bottom, we have the 200 above it, and we have the 50-period moving average above that. So it's telling me that we're potentially in a long setup. So with us having that, waiting for price to come back and retest the moving average within the time slot that I want to get involved in the trade. You can see here that we're below the moving average at that time, so I'm not going to get involved. You can see prices flip-flopping around, just continues to flip-flop around. We don't have a setup. The trend looks to be changing around this area, looking like it wants to change to the downside. And you can see here that it did change to the downside, and we have the nice the 50-period moving average crossing over the 400 right here. And that's telling us that we are potentially looking to start going down, right? And it continues moving down until we have the indication that we are in a downtrend, because we have the 400 above, the 200 in the middle, and we have the 50-period moving average at the bottom. So once we have a situation like this, we can now start looking for reasons to go short, right? So you can see it right here. From around this area, we have reasons to look to go short, okay? This is not coming in at the right time because it's coming in before 2 p.m. Eastern, 2 a.m. Eastern Standard. So this is not one that I want to get involved with. You can see we did get the retest. You can see this is 1, 2, and 3, but it's happening too soon. I want to enter trades in the European session and the US session, okay? So I'm going to leave that one alone. Here it pulled back, but we didn't get that touch. So we can leave that one alone as well. Pulls back here. We got the touch, definitely we got the touch, but it's happening at around 11 a.m. Eastern Standard, where we got the first candle hitting the 50-period moving average. The next bar is at 12 p.m. Eastern Standard. It's closing back below. Not an ideal situation for me because of the time that it's happening. It's happening at a time when volatility could be very low. So that's not the time that you really want to get involved in a setup like that. Okay, so I'll leave this one alone because volatility is low. If I did get involved, you can see that price would have gone to the downside, but then spiked up, then pushed down again. So this is not a situation where I'd want to be getting involved in the trade. Okay, price continues down, pushes up again, closes above the moving average. We're not going to get involved. It continues moving up. We're still not going to get involved. It continues moving down. It starts to move down. With the price moving down, it closes below the 50-period moving average. It's doing that within the time slot that I'm looking for. Are we going to get a retest? If we get a retest, as in price pulls back, retest the 50-period moving average. In this case, it closed above. If it closed below, I can go short, but it closed above. So it closed above, so I'm going to have to look through my next bar. The next bar closed back below, I can go short. If I go short, my stop above, you can see here that price didn't go below the current low that we're looking at. Okay, price didn't go below it. Price continued just going sideways. So it pushes back to the upside, closes above the 50-period moving average, and it stays above the 200-period moving average. Okay, so when price pulls back to the downside, it goes below the 50-period moving average, and we have the nice order that we're looking for, 400, 200, 50. Then what we want to do is look for a retest. Okay, here we got a retest, not a perfect retest, because if we got this bar closing below after hitting and we entered short, the stop would be just above, and this bar here would come stop us out. Okay, so you can see here that this would have been a stopped out trade because of this bar, and you can still see that price is going sideways in the European session, starts to move up in the from the European session. This is the Asian session where price is going sideways. In the European session, price starts to move to the upside. However, at the time that the price starts to move to the upside, we need to make sure that we have everything in place and paying attention to the fact that price is closing above the 50-period moving average, and it continues closing above. So you're not necessarily looking to enter any trades. Okay, so you leave it alone, let it do its thing, and wait for a formation to come in. Let's see. We have 400, we have the 50 in the middle. We need the 200 in the middle to give us some sort of directional bias. Okay, so here it changed and gave us an uptrend. We have the 400, we have the 200, we have the 50. So this is an uptrend. We're looking for the price to pull back and retest the 50. Here we have the price pulling back, retesting the 50 period moving average. So you can see a nice three-wave pullback. This is 1. This is 2. This is 3. Okay, so that's a nice three-wave pullback. And this is a little bit more of a complex correction. This is one of those that we'd look at and call a WXY XZ correction. So this could be, we can do this in so many different ways. This could be done like this. Right, so this could be WX and this is Y, or this could be WXY X and this could be Z, right? So it can be looked at in different ways, but this in essence is a correction, whether it's a three-wave corrective formation or whether we want to look at it as a WXYXZ, which is a five-wave corrective formation. Either way, it is a corrective formation. So the best thing for you guys to do is make sure that you understand what your Elliott wave corrections look like, because the end of the correction is where you want to be getting into a trade. Okay. Sometimes a correction can evolve and sometimes it does not evolve. So in situations where it does not evolve and you see that price hits that 50 period moving average, it's going to give you a nice setup. Okay, so here you can see it came back, it hit the 50 period moving average, and we could be looking to go long once the price closes above, right? So the price closed above, we can look to go long, the stop goes below the low, and we can hold on to our trade to the upside. If we're swinging, we can hold on to it to whatever profit target that we set. If we're day trading, we would want to hold on to this trade maybe until 12 p.m. Eastern Standard or until around 4 p.m. Eastern Standard. Okay. Any questions, guys? Anything at all that you're not too clear on? Okay. Let's see here. Ryan says, wow, this is super useful. Ryan says, nope, really good. We'll watch this again. Anyone else? Jennifer says, why did you select 50, 240? Okay, so the 400 moving average basically gives you the average price of the last 400 bars. Okay, so that kind of gives you a longer term view of the price, where it's heading longer term. Okay, you don't really want to have too long of a term because, as you know, price moves up and down. So you want to be able to catch the trend as early as you can and have an idea of what the trend is on the longer term, the medium term, which would be 200 period moving average, which is 200 candles. And you want to also know what the directional trend is on the shorter term as well, which is the 50 period moving average, which is the previous 50 bars. Okay, so that's basically giving you the average price of the previous 50 bars, the previous 200 bars, and the previous 400 bars. So it gives you a nice smoothing out of the direction of the price from three point of views: long, medium, short. Okay, so it kind of gives you an idea of where the price is headed without really having to understand other methods like trend and so on. Okay, you don't have to go back and draw trend lines and all of that to kind of give you an idea of how the price is moving, what the directional bias should be, and so on. The moving averages can give you a very good and clear view of that. Okay. Anyone else? Any other questions? Ryan says, so you only use 1 hour here. I like using the 1 hour candlestick chart above everything else. So I like using the 1 hour candlestick chart. This is the chart that I focus the most on. For lower time frames, let's say like 15 minutes, 5 minutes, 30 minutes. 30 minutes and 1 hour is basically almost the same for me, but I prefer the 1 hour because it smooths out the price a lot more. 4 hour may not smooth it out as much as I would like, because there could be a lot of up and down movement inside of that. So it's not necessarily ideal for day trading on the 4 hour time frame. The 1 hour time frame would be best for that. Would be giving me the smoothest moves throughout the course of the day. Lower time frames from 1 hour for, let's say, 30 minutes down, I would look at that as more of a scalping type technique. Okay. Jennifer says, excellent class. I like the 1 hour also. Thank you so much. The 1 hour, in my view, it's best for day trading. Ryan says, so trend 4 hour entry, 5 minutes. Okay, I think you're saying you look at the 4 hour time frame for trend and you look on the 5 minute time frame for your entry. Is that what you're saying? If you're saying that, no, that's not how I look at it. The 4 hour time frame, yes, it could give you a nice idea of what the trend could look like if you're drawing trend lines, right? But I prefer to trade on the 1 hour time frame. I'm entering on the 1 hour time frame. I'm closing out trades on the 1 hour time frame as well. Okay. Some traders may want to close out trades on a lower time frame because they're going to be looking at candlestick patterns or candlestick formations to see if there's a high probability of price moving against their trade so that they could get out. Okay, so they would want to go to a lower time frame. Okay, with me, if I have like my set profit targets for whatever reasons that I choose, if I'm using order blocks or if I'm using market geometry or whatever methods I'm using, I'm waiting for price to get to that area. Okay. Once price gets to that area, I'm looking to exit. So I don't necessarily have to go down to a lower time frame to find my exit. Okay. Anyone else? Any other questions? In our next class, we will cover moving averages as well, and we will incorporate moving averages with another technique. Okay. We could also use the moving averages with the Elliott wave theory along with other techniques. So we can also touch on that as well. Okay. Okay. Jennifer says, thank you for the training. You're most welcome, Jennifer. Thank you so much, everyone else. Thank you guys for coming. I'll see you guys on our next class. Bye-bye for now. Have yourselves a wonderful evening. Have a wonderful weekend. Bye-bye. Bye, everyone. Have a good evening.